Hello everyone. In this part of the video, uh, we will talk about foreign exchange rates. Okay. So the first thing to understand about foreign exchange rates is how those foreign exchange rates are quoted. So there are two ways for foreign exchange rates quote. One is direct quote, other one is indirect quote. So direct quote means home currency prices of 1 unit of foreign currency. Now what does that mean? Look, we are in United States, right? In the US, we basically just consider the foreign currency like any other commodity that you buy. So you want to see the price of that commodity in terms of dollars. So how many dollars will you have to pay to get 1 unit of, let's say, anything, one phone, one pen, one calculator. So that's what the price of a calculator is. So when home currency is dollars, right? So per unit of foreign currency prices, when they are quoted in terms of home currency, that is called direct quote. Indirect quote is basically the reciprocal of direct quote. Now here the foreign currency price of 1 unit of home currency. For example, it shows right here $1.30 per euro. This is direct quote because we are in United States. We want to know everything in terms of dollars. How many dollars we need to sacrifice to get 1 euro, right? Or what is the price of 1 euro? This is per euro. So 1 euro is equivalent to $1.30. If you take the reciprocal of 1.30, that is 1 divided by 1.30, this whole thing turns upside down. Now that will be euro in the numerator and dollars would be in the denominator once you will take the reciprocal. So it becomes 0.7692 euros per dollar. Okay, this is called indirect quote. So this is direct or indirect quote in the US. Okay, so this is the direct quote in US because home currency is US dollar. So the price is reflecting that this is the home currency price of 1 unit of foreign currency. Here we are saying this is the foreign currency here in the US. So foreign currency prices per unit of home currency. Okay, but if we are seeing these rates, let's say we are in Germany, right? For Germany, euro is the home currency, right? So in Germany, the second quote right here, 0.7692 euros per dollar, would be the direct quote, and this one right here would be indirect quote. Okay. Always remember, direct quote and indirect quote are nothing but reciprocal of each other. Okay. Now, when we talk about these currencies, we hear the rates, different rates, spot rates or forward rates. Now, what is spot rate? Spot rate is today's price of the currency for delivery today itself. Okay, the price is set today and delivery also has to be made today. Let's say you want to import a car from Germany, so you need some euros, right? So you in the foreign exchange market, you will get the euros from foreign exchange market, and you see how you want to know how many dollars will you have to sacrifice today. So you will see per euro, let's say the price of the car is 30,000 euros. Okay, so the dollar value per euro is 1.30. So if you want to buy 30,000 euros, if you need 30,000 euros to buy that car, the value becomes 30,000 times 1.30. That would be the number of dollars required that you will pay. Okay, so since you need that currency, so it would be $39,000. Okay, so if you want to get those euros today itself, that would be considered as spot rate. Okay, or in other case, the situation can be, let's say after 3 months, you want to buy the car after 3 months. Okay, so you want to lock in the price today itself, because you know there are a lot of fluctuations going on in the market, right? And you just want to get away with those fluctuations. You just do not want to get into those fluctuations. So you want to lock the price today. Okay, so if the price is settled today, but the delivery of that foreign currency will be made sometime in future, those rates, the rate which are decided today but transaction would be settled in future, those rates are called forward rates. Okay, forward rates are generally like 30-day forward rates, 90-day forward rates, or 180-day forward rates. These are the rates that we see in foreign exchange market for the currencies. Okay, so now what is forward premium or forward discount? If the forward rate is greater than the spot rate, that means the currency is selling at forward premium. And it is also possible that the other currency is getting weak. So the forward rate, if it is less than the spot rate, that is considered as forward discount. And if you want to calculate what is the annualized forward premium or discount, this is the formula that you will use. This is the forward rate. Let's say the forward rate for the same currency turns out to be $1.45 per euro. Okay, so 1.45 minus 1.30 divided by 1.30, that since a forward rate is greater than the spot rate, it becomes what? Forward premium. Okay, and to annualize it, and if let us assume it is 3 months forward rate, so and on an annual basis it would be 12 divided by 3 times 100. That would be annualized forward premium. Okay, if instead of 1.345 the forward rate 3 months from now is, let's say, 1.28, if that is the case, then forward rate is less than the spot rate, then this would be considered as forward discount. Okay, this table shows direct quotes of different currencies. Australian dollar with US dollar. These are the direct quote, 1.0245 8 US dollars per Australian dollar in the year 2013 and 2015. Okay, so these are the exchange rates. Some of the currency they change in value a lot, like for example you can see here Australian dollars, whereas UK pound is pretty much close to each other in those two times. Canada, it's changed a lot. So some of the currencies they fluctuate a lot, they change a lot, but some of them remains pretty much stable, not much changed. Like this is how you see forward rates, like 1 month forward rate, 3 months forward rate, or 6 months forward rate. It's some places you will see 30-day, 90-day, or 180 days forward rate. And if that is given in terms of days, so this is how we do it. Instead of 12 divided by 9, we use 360 divided by whatever 365 divided by whatever the number of days are. Okay, now just like forward, in that forward market there can be two types of contracts. One can be forward contract, other contract can be futures contract. If you remember in the previous video, I talked about the international diversification, that if an investor is willing to invest internationally, the investor gets the benefit of international diversification. First thing, I would like to give you an example of how that international diversification is beneficial. Let's go back to past in the year 2008 and 2009. It was a global financial crisis, okay, which was triggered by US economy. There was some housing bubble. We will discuss in detail about it in like going forward. There was a housing bubble in the US, and that housing market finally crashed, and that basically gave rise to that global financial crisis. The markets, globally, the markets were doing really poor. The GDP growth rate for a lot of countries was negative. For some of the countries, it was close to zero. But there were some third world countries which were doing really good. Those countries had like 4 to 5% of growth rate. They were able to maintain 4 to 5% of growth rate. That was the time when French president, I believe, visited India, and in one of his speeches, he mentioned that this is the time when we are struggling to maintain a 0% growth rate in France, and India is showing a growth rate of 4 to 5%. It is amazing. Why is that? Because the political situation, the other situations, the market, Indian market is not that much connected to the US market. At that time, it was not to that extent it was connected to the US market, like imports and exports and in those terms. That was the reason why that shock could not transfer to Indian economy. It was more of self-sufficient kind of self-reliant kind of an economy, where most of the manufactured product was used in the country itself, that was consumed in the country itself. So that international level financial crisis, that did not affect it, because their export-import situation, that didn't get affected much. But the countries which were exporting a lot of their product to the United States, they got adversely affected by that those crises. So closer the ties, more impact those countries showed. Okay, so that's what international diversification mean, because the macroeconomic scenario of different countries is different. So if there is an adverse impact on one country, it does not necessarily give the same impact in the other country. And if some of your investment is in that country, you might probably be saved. Okay. Now, similar to that example, a very similar situation happened now during COVID. The economy of Bangladesh did really good. They didn't do, whereas most of the economies were struggling, but it was not the case with Bangladesh. They showed like really good GDP growth rate during this time as well. Okay, so this is the benefit of international diversification. Okay, but with this benefit comes with some kind of risk, and the biggest risk is foreign exchange fluctuations. Let's say you have invested something in India. Let's say your investment was in India. Okay, Indian currency is doing really poorly. Earlier, the exchange rate was like if let me tell you in direct terms. It was 0.015 US dollars per Indian rupee. Okay, but today the situation is really different, and now the exchange rate is 0.013 per dollars per rupee. Okay, so if you have to bring your investment back from India, you will end up getting less number of dollars because the value of Indian currency is going down. Okay, so this is the risk, that because of foreign exchange fluctuations, you may have to end up you may have to satisfied with less number of dollars. Ultimately, if you are in United States, if you are living here, no matter where your investment is, you would definitely like to convert your investment back to the US dollars, right? And if that currency is getting weak and weak, you will end up receiving less number of dollars, even if your returns in foreign currency was great. But when you converted that back to the US dollar, that return was like really poor. You didn't get anything, right? So this is the situation. This is the risk that one has to bear. Generally, if you are involved in international trade, the contracts are not settled on the same day. Today you place the order, the other party takes some time to fulfill that order, and then you have to make the payment. So if you decide the price in terms of dollars, that foreign exchange rate fluctuation, I mean, for you it is okay because you have to give them the dollars only, that's okay. But the one who is trading on the other end, for them, they would like to convert those dollars to their home currency. So it's risky for them. Or if you want to get something from Germany, so let's say you placed an order for BMW cars from Germany, right? If that is the case, you might have to pay in euros. So if the foreign exchange, because of foreign exchange rate fluctuations, you might end up paying more euros than you actually, more dollars, sorry, than actually, although euro price is stable, but foreign exchange rates changes forced you to pay more dollars, because you have to convert those dollars back to the euros. If you have to pay, let's say, 1 million euros, right? For 1 million euros, maybe now you will end up paying more dollars because the dollar has weakened over time, right? So those situations, any businessman cannot survive in this much of uncertainty. No business can survive with that, right? So because if your prediction go wrong, it's really hard. Okay, so sometimes they want to hedge against that risk by locking in a future price, and that's where these forward contracts or future contracts come into play. Okay, so the price would be decided today, but the delivery of euros would be, you need 1 million euros, so the delivery of euros would be like, let's say, 3 months from now. Okay, at the price which has been locked today. No matter what is the price on that day, you will get euros at the price which is locked in today. So that's how you somehow hedge the risk to some extent. Okay. Now you would ask the question, okay, you just said, okay, these are those forward contracts. These are futures and forward contracts. Both of them have these similar characteristics. The difference between forward and futures contract is that futures contract are standardized contracts which are traded through exchanges, whereas forward contracts are customized contracts. There some financial intermediaries is there in the middle, and the contract is between two parties depending on the requirements of those two parties. Okay. Whereas like futures contract, you can anytime buy those futures contract from let's say CME, Chicago Mercantile Exchange, like that. These contracts are there, so you can anytime lock that in. Maturity date is fixed, amount is fixed, and they are traded through the exchange, and they have a feature of marking to market. So every day, depending on the price of that futures contract, the transaction is settled on a daily basis. Okay, I do not want to go into much details of how this marking to market takes place. It is done. I don't want to do that because then it will be too much for this course. Okay, you will study all this in your international finance class. Okay, so for foreign currency, other than forwards and futures, there are some options contract as well. The options contract gives you the right but not the obligation to buy or sell the currency. Okay, you have to pay some premium called option premium, and by paying that option premium, you get a right to buy the currency. Okay, that is not an obligation. So you will see the market price on that day, you will see the contract price as per your options contract, and then you will decide whether you want to buy that currency using that contract or you want to let the contract expire. Okay, this is call option when the contract is for buying the currency. When the contract is for selling the currency, that is called put option. For example, if you have to make payment in 1 million euros, you will enter into a call option because you would like to buy 1 million euro 3 months from now. If instead of importing, if you are exporting something to Germany, okay, let's say Ford is exporting cars to Germany, and the German importer is going to pay 3 months from now in terms of euro only, but you would like to convert your euros back to US dollars. So you would, in a sense, you would be selling euros for dollars, right? You would be selling those euros. So that would, in that situation, you will enter into put option. Okay, your contract would be considered as put option because you are willing to sell foreign currency now. Okay, and another categorization for options is American and European options. American options can be exercised at any time. Like there is a deadline, but before the deadline, anytime you can exercise those American options. European options, I mean, it's not that European options are traded only in Europe. That is not the case. Okay. In America, we see a lot of European options. European options are those options which can be exercised only on expiration date. There is a certain expiration date for options contract. In case of European option, the contract, that option can only be exercised on that certain date, which is expiration date. Whereas in case of American options, those contracts can be exercised at any time. Okay. Now, let's talk about market efficiency. The concept of market efficiency lies in the heart of finance. Okay. Whatever we do in finance, these valuation models, whatever, all these models assume that the market is efficient. If the market is efficient, then only you will be able to provide a value to that enterprise. Okay, so in an efficient market, the stock prices provide an unbiased estimate of the true value of an enterprise because market is efficient. So whatever stock price is, that actually reflects the true value of the enterprise. It reflects a present value estimate of all future expected cash flows, evaluated at an appropriate required rate of return. Okay. Always remember, if the market is efficient, two stocks which carry exactly the same risk, they should provide exactly the same return. Okay. Otherwise, what will happen? If we know that one is providing more returns, although the level of risk is exactly the same in both the situations, definitely everybody will rush to buy that investment which is giving you higher return. And then what will happen? The price of that stock will go up because a lot of people are buying that stock. because of more buying pressure, the price of that stock go up, and ultimately the return will go down, because you are buying it at a higher price, so return will go down. Okay, so in an efficient market, return is purely the reflection of risk. You can earn high return only if you are ready to take more risk. At same level of risk, the return would be exactly the same if the market is efficient. Okay. So market efficiency, how would you measure market efficiency? Market efficiency measure would be like how efficiently or how quickly the information is reflected in the stock prices. That is market efficiency. So capital markets are efficient if security prices instantaneously reflect in an unbiased manner all economically relevant information about a security's prospective returns and the risk of those returns. If there is an information out in the market regarding Toyota, okay, that says that Toyota has successfully started making its that has like done the drive test for its electric cars, and they are bringing their electric cars in the market in next 10 days, and their electric cars are more efficient than Tesla. Okay, you will see instantly the Toyota stock price will shoot up. And why would that happen? Because of the better prospects of Toyota. If like they are getting something which is better than Tesla, so they would be biggest competitor of Tesla. Their electric cars are expected to do better than Tesla. So in that case, what's going to happen? We would expect that in future Tesla's electric cars will be sold quickly. Tesla will generate more revenue, and that revenue will ultimately go to the pocket of the shareholders. Their cash flows would be better, so the stock price will go up. So this information about Toyota, it will get reflected in the stock prices immediately. Okay, so that means the market is efficient. Everybody got the information, everybody had the access to information, and everybody reacted to that information. Okay, so there are three forms of market efficiency: weak form of market efficiency, semi-strong form of market efficiency, and strong form of market efficiency. In case of weak form of market efficiency, if the market is just weak form efficient, that means what? That based on that technical analysis you cannot outperform. Let's say technical analysis means you are analyzing only the past stock prices. You will see what was the trend of this particular stock during the whole year. Okay, you will study that trend, and based on that trend you decide to invest. Okay, now the prices are low, but I know like January effect, as you will see, it happens that during December the stock prices are generally low, and suddenly they shoot up in the beginning of like first 2 days of January and last 5 days of December. So like Santa Claus rally, this is called Santa Claus rally. And if that is the case, so if you see that this kind of trend is prevalent forever, for a very long time, you would like to invest like maybe 5 or 6 days in before that in December, and you would like to sell your stock on 2nd of January, and you will earn that return. But a lot of investors like you will be doing the same thing. If they are doing the same thing, then definitely the prices will go up in December itself, right? And you won't be able to make extra returns than them. Okay, so in weak form of market efficiency, the past prices, any information given by the past stock prices is already reflected in that stock price. So you cannot generate any abnormal return just by studying the past prices. And US market is considered to be that weak form of considered to show weak form of market efficiency. In case of semi-strong form of market efficiency, any publicly available information, those past prices as well as, let's say, any announcement, CEO is changing, Tesla is coming up with a new plan, any kind of new announcements. Everybody knows about those announcements and everybody can see the impact of those announcements. Everybody has already reacted, instantaneously reacted to those announcements. So the stock prices reflect the impact of those publicly available information along with the past prices. Okay, and you cannot make any abnormal return by acting on that, because everybody has instantaneously acted and the stock price is already reflecting that information. Stock price is already high to show better prospects of that firm. So if you are trying to make a return, if you are trying to make some abnormal return, no, you cannot, because stock price has already shooted up. And now with high stock price, if you are buying a stock, how do you think that your returns would be abnormally high? No. Then in case of strong form of market efficiency, the stock prices reflect all the information, be it publicly available information, be it the past prices, or even the private information is reflected in the stock prices. So nobody can get abnormal returns. I'm using a term abnormal returns. That means what? The return over and above the risk profile of that firm. Because return has to be a reward for risk only in case of efficiency. If you are taking high risk, you can definitely have high returns, but you cannot have high returns with the same level of risk. Okay, so if you are getting returns higher than the risk profile, that is called abnormal return. So you cannot have any abnormal return in case of strong form of market efficiency. Okay, you find out any information, all the information is already reflected in the stock prices. Okay, now what is the implication? What are the implications of market efficiency for those financial managers? Okay, so the financial managers may decide sometimes the financial managers decide to delay the issuance of the securities or the new bond, assuming that, okay, the securities would be sold at a higher price. But if the market is efficient, that can turn out to be this kind of expectations for timing, better timing, can turn out to be like a gambling, which may or may not produce the desired results. Because we have already talked about it, if the markets are efficient, then you cannot get any abnormal return. If you are waiting for a good time, everybody sitting out there is waiting for the same time, right? And they will start accordingly, they will start reacting to it, and you won't be able to get that. Okay, so if the markets are efficient, those market timings are not possible. To time the market, it is not possible. So the financial manager to get a better price for their shares or lower interest rate when they issue bonds, that can turn out to be just like gambling. Similarly, in case of efficient financial markets, all the securities would produce zero NPV. Zero NPV means the present value of all expected cash inflows minus cash outflow is zero. Or in other words, I can say there would not be any abnormal return. So because the present value of all those expected cash inflows, that reflects the required rate of return, that reflects, because when we are trying to discount them, we divide that by 1 plus R. So that R reflects the, according to the risk portfolio, the required return from that stock based on the risk portfolio. So you will get your actual returns would be exactly equal to the required returns. So zero abnormal return. Okay, so there won't be any abnormal returns if the markets are efficient. that corporate diversification. For example, if a firm is entering into a merger contract just for the sake of diversification, the benefits of diversification. If the markets are efficient, the firm doesn't have to take the step of this expensive and unnecessary corporate diversification, because in efficient markets, the shareholders, they can diversify their portfolio on their own. They can buy the shares of two different companies, like the two firms that are planning to merge just for diversification's sake, and go through this expensive process. They can rather avoid going through expensive process. If the markets are efficient, the investors can hold the security of both the firms, and they will, because ultimate objective is to improve the wealth of the shareholders, and that wealth of the shareholders can be improved by them, by those shareholders themselves, with their personal level diversification. They can do that easily. Okay, so the financial manager doesn't have to go for this expensive step. And then security price adjustment. In case of these efficient capital markets, security prices reflect expected cash flow and the risk of those cash flows. So if any transaction like accounting change, if it doesn't have any impact on the cash flow or the risk of those cash flows, then definitely that transaction should not affect the security prices also. So investors, you cannot befool the investors by changing in some accounting, because in case of efficient markets, the investors will get to know that whether it is affecting the cash flows, whether it is affecting the risk profile. If not, then it's useless. Keep doing whatever you are doing. Investors will value the security in the same manner. Okay. Then market efficiency, there is the other aspect of market efficiency, which is behavioral finance. Market efficiency assumes that all the investors are rational investors. They always value the firm based on their expected cash flows, their prospects. But behavioral finance perspective says something else. They say the investors have some psychological tendency, and those psychological tendency force the investors to behave in some irrational manner. And because of their irrational behavior, the market stock prices do not reflect exactly what the price should have been. Okay, so sometimes investors refuse to sell a losing stock. They keep on waiting for the stock price to go up, and they are waiting, okay, once whatever I invested, once this will reach to that point, I will sell the stock at that time. They are not reacting to the actual information. Rather, they are thinking about that to go back. I mean, they are not behaving rationally here. Okay. Same way, fixation on a price target for the stock, filtering out evidence that investors may be wrong. Okay. Tendency to focus too heavily on up or down price trends. So these are some of the, while when they are doing all that, they completely ignore the actual information which is out there in the market. Okay. Now, holding period return. Holding period return is like the time period for which you hold a security, all the returns made during that time period. And the return would be, it consists of two components. One is the price change, and second one is any distribution in terms of dividend, etc., whatever you have received from that firm. Okay. So ending price minus beginning price would give the difference of the price differential. This is one component of the return. The second component is dividends. During that time, whatever dividend have been received. So this is the total return. If you the total amount that you received, and if you are calculating the return, divide that by the initial investment, whatever you made, which was the beginning price, times 100. Okay. So there are two kinds of return. One, actually realized returns. Realized return is like after it has already been done, the stock has already been sold. Expected return is the return that you predict beforehand, that what would be the return. By predicting that return, you decide to invest in that stock. Okay. So realized return is kind of like backward looking, whereas expected return is forward looking. Okay. Now, the financial crisis of 2007. What was the reason? The major reason was real estate bubble. Housing prices were going up. So at that time, people decided to invest in real estate. Okay, so they were buying houses more than they were required to, right? So one person was having like 2, 3, 4 different houses because they were saying that there was a hike in the housing prices. So they decided to make some easy money. They started applying for loan. At that time, interest rates were really low. So because of low interest rate, a lot of people applied for the loans, and the loans were not loans were being issued without even their proper credit scores or credit history. Okay, so that was the reason why a lot of people could get the loans. They bought the houses. A lot of proportion was like the loan basis. Then later on, the housing prices got crashed and housing prices came down because this was not the actual demand of the houses. It was just a bubble. It was just a speculation kind of a thing. When the market actually realized it, there were no buyers in the market for the houses at a time. And when there were no buyers, people could not. They already bought the houses at very high prices, but now, since there were no buyers in the market, there was low demand for houses in the market. Then the house prices went really down. When this happened, because of those low house prices, people were not able to repay their loans. Now, their loans were securitized. Against their loans, some securities were issued. So this mortgage was subprime kind of mortgage where all good quality, bad quality, all the loans were merged together and some securities were issued against them. When the borrowers started making defaults, they decided to make defaults because the house price was even less than the outstanding amount of loan. Then they decided to give up the house. Okay, I just do not want, because I will end up paying more in terms of loan, and by selling the house I will get less. So they decided, they started giving the houses up, and the banks, because the loans were provided against the security of those houses, so the banks had to sell those houses, and when they were selling those houses, they could not get the complete loan back. And those loans were securitized. Okay, so some securities were issued against those loans. If there were defaults there, the impact went to the end investors. Okay, so this basically spread all over. So in the firms, like, of course, those investment was there. So from the firms, there were a lot of investors. So they lost a lot of money. So to make up for that loss, they had to cut employment. Business cut back because of low demand. Overall aggregate demand decreased because of all that. And aggregate demand decreased, so the firms had to go through recession. Employment rates were high, and it became a kind of vicious circle where this high employment rate further decreasing their buying capacity or the purchasing power, further decreasing the overall aggregate demand. And if the demand is less, then obviously every business had to cut their production levels. Okay. So at that time, some firms which had less business risk and tight control on their cost, they could survive in this kind of a storm. Otherwise, nobody could. And that was the time. Look here, right here. So this is 30 years fixed rate, 15 years fixed rate, and 1 year So this is what happened to the mortgage interest rate. Here mortgage interest rates were really low, which basically pushed up the housing bubble, this price, because a lot of people wanted to take the benefit of these low interest rates. So then the interest rates started rising a little bit because of a lot of demand for loans and all that. Okay, so it was triggered from here, this low level of interest rates. This was the beginning. And then here, if you look at this industrial average, overall what happened to the market? Market was doing good before that, but after this bubble burst, the market went really down to very low levels. Okay, so this is all that effect that could be seen on the overall economy. It started with housing prices or the real estate, and then it spread to the whole economy. Okay, so these kind of incidents give us some lessons. The major drawback, the major issue here was this thing, securitization of those some subprime mortgages. Like all kind of loans were securitized. Some securities were issued, and even I mean, worst quality loans were also included in them. So these things further aggravated the situation. Okay, so that's all for this chapter, and I understand that it can be little bit boring because it was just talk, but it won't be the case starting from next chapter, where we will have a lot of calculations to do. Okay, so all right, that's all for this chapter, and please email me if you have any questions or concerns or any doubts on whatever I just explained. All right, thank you so much. Have a great time ahead. Bye bye.